VTI and VOO are two of the most popular ETFs for long-term investors. And honestly, both are excellent. Both are low cost, both are simple, both are easy to use inside a long-term portfolio, and both can help investors avoid the mistake of trying to pick random individual stocks. But if you could only buy one ETF in 2026, which one should you choose? VTI or VOO? That question sounds simple, but the answer depends on what you actually want your portfolio to own. Do you want the S&P 500 or do you want the total US stock market? This is not a good ETF versus bad ETF debate. This is a portfolio design decision. The first thing to understand is that this is not a fight between one smart choice and one dumb choice. VTI and VOO are both strong ETFs. That is what makes a comparison interesting. If one fund were obviously bad, the decision would be easy. But here, both funds are cheap, popular, long-term friendly, and simple to own. So the real question is not which ETF is good. The real question is which exposure do you want? VOO gives you the S&P 500. VTI gives you the total US stock market. Those sound similar, and in many ways they are, but they are not identical. So let's start by looking at what VOO actually gives you. VOO is Vanguard's S&P 500 ETF. In simple terms, it gives investors exposure to about 500 of the largest publicly traded companies in the United States. That makes VOO clean, familiar, and easy to understand. For beginners, this is important. You are not buying one company, you are buying a basket of large American companies through one ETF. For intermediate investors, the next detail matters. VOO is market cap weighted. That means the biggest companies have the biggest influence inside the fund. So VOO gives you strong exposure to the largest companies in America, but it does not give you the entire US stock market. It gives you the biggest part of the market, not all of it. The strength of VOO is simplicity. It is easy to explain, easy to understand, and easy to use as a core holding. If someone wants basic US large cap exposure, VOO does that job very well. But the trade-off is that VOO is narrower than a total market ETF. It does not include the full universe of US stocks. It does not give the same direct exposure to mid-caps, small caps, or micro caps that a total market ETF does. That does not make VOO bad, it just means investors should understand the role. VOO is diversified, but it is not the entire US market. So now the natural question is this: what does VTI add that VOO does not? VTI is Vanguard's total stock market ETF. Instead of focusing only on the S&P 500, VTI is designed to give broad exposure to the US stock market. That includes large-cap stocks, mid-cap stocks, small-cap stocks, and even micro-cap stocks. So if VOO is a clean S&P 500 fund, VTI is closer to a one ETF way to own the US stock market. For investors who want broad domestic exposure without choosing between large companies and smaller companies, VTI can be very attractive. It says, do not just buy the giants, buy the whole market. But there is one detail many investors miss. Total market does not mean equal weight, and that matters a lot. VTI is broader than VOO, but broader does not mean every company gets the same weight. VTI is still market cap weighted. That means the largest companies still dominate the fund. Small caps are included, mid caps are included, micro caps are included, but they do not have the same influence as the biggest companies in America. This is why VTI and VOO can often behave more similarly than beginners expect. VTI owns more companies, but the largest companies still matter most. So when you buy VTI, you are getting broader exposure, but you are not getting an equal bet on every company in America. That leads us to the real difference between the two ETFs. The real difference is exposure. VOO tracks the S&P 500. That means it focuses on large US companies. VTI tracks the total US stock market. That means it includes large caps, mid caps, small caps, and micro caps. A simple way to think about it is this. VOO owns the giants. VTI owns the giants plus the rest. That is the whole comparison in one sentence. VOO gives you cleaner large cap exposure. VTI gives you broader US market exposure. Neither approach is automatically right for everyone. The better choice depends on what role the ETF is supposed to play inside your portfolio. When both ETFs are good, the decision has to come from portfolio design. Ask yourself a few simple questions. Do you want direct S&P 500 exposure? Do you want the total US stock market? Do you want small caps included automatically? Do you want the simplest possible large cap core? Do you already own small caps somewhere else? Do you plan to add international stocks? These questions matter more than internet arguments about which ticker is better. The ticker is not the goal. The portfolio is the goal. And once you think this way, the VTI versus VOO decision becomes much clearer. But before picking one, we need to talk about overlap because these two funds are different but not completely different. VTI and VOO have a lot of overlap. That happens because VTI includes the S&P 500 companies too. And because VTI is market cap weighted, many of its largest holdings are also among the largest holdings in VOO. So yes, VTI is broader, but much of the portfolio is still driven by the same large US companies that drive VOO. This is why their performance can often look very similar. It is also why owning both funds may not add as much diversification as people think. VTI and VOO are different, but they are not opposites. They are more like two versions of broad US stock exposure. One is broader, one is more focused. That distinction matters before you combine them. A common mistake is buying both VTI and VOO without understanding why. Many investors think more tickers automatically means more diversification. But if two funds own many of the same large companies, the portfolio may not change very much. You may just be doubling up on the same core exposure. That does not mean owning both is always wrong. There may be tax reasons. There may be old positions. There may be a deliberate tilt toward large caps. But buying both by accident is not strategy, it is clutter. A cleaner portfolio starts with asking one question. What does this new ETF add that I do not already own? If the answer is not clear, the portfolio may not need another ticker. Because VTI and VOO overlap so much, their performance can often look similar. That does not mean they are identical. But it does mean investors should not expect one of them to completely destroy the other over long periods just because of the ticker. Both are heavily influenced by large US companies. Both move with the broad US stock market. Both have low costs, and both are designed for long-term exposure, not short-term excitement. The performance difference usually comes from which part of the market is leading. If mega caps and large caps dominate, VOO can look stronger. If smaller companies in the broader market do better, VTI may benefit more. So the winner can change, and that is the point. The winner between VTI and VOO can change depending on market leadership. When mega-cap stocks dominate, VOO may look better because it is more focused on the largest companies. When mid-caps and small-caps recover, VTI may have an advantage because it includes more of that broader market exposure. This is why it is risky to choose based only on recent performance. Recent winners can change. Market leadership rotates. And what worked best in the last few years may not be what works best in the next few years. So the better question is not which ETF recently won. The better question is which exposure do I want to hold through different market cycles? That is a more useful long-term question. Now let's look at cost. Cost does not really decide this comparison. Both VTI and VOO have an expense ratio of 0.03%. That is extremely low, and it means the decision is very different from a comparison like SPY versus VOO, where cost can be a bigger part of the argument. Here, cost is basically a tie, so investors need to focus on exposure, simplicity, portfolio role, small cap preference, overlap, and account structure. That is actually helpful because once cost is out of the way, the decision becomes cleaner. Do you want the S&P 500 or do you want the total US market? But before choosing, we also need to understand risk because broader exposure does not mean safe exposure. VTI is broader than VOO, but broader does not mean safe. VTI can still fall hard during bear markets. It still owns stocks. It still carries market risk. And because it includes smaller companies, it can have exposure to areas of the market that may be more volatile. VOO has risk too. It may be more concentrated in mega-cap companies, and if the largest companies become expensive or struggle, that can pressure the fund. So both ETFs can drop. Both require discipline. Both require a long-term mindset. The difference is not risk versus no risk. The difference is which type of market exposure you want to accept. That is why we need to compare the risks directly. VTI and VOO have different risk profiles. VTI gives broader exposure, but that includes small-cap volatility and total market drawdowns. It is broader, but it is still heavily influenced by large companies. VOO gives cleaner large-cap exposure, but that also means more dependence on the S&P 500 and less direct exposure to smaller companies. It can also become heavily influenced by mega-cap stocks. So the choice is not about avoiding risk, it is about choosing which risk fits your plan. Some investors prefer the cleaner S&P 500 exposure of VOO. Others prefer the broader market coverage of VTI. Both approaches can work, but neither one protects you from the emotional challenge of holding through volatility, and that is where discipline matters. This is exactly the kind of ETF comparison we focus on at Boring Money Wins. Not hype, not panic, not pretending that one good ETF has to make another good ETF look terrible. Just clear investing frameworks that help you understand what you own and why you own it. If this kind of no-hype ETF breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow and it tells YouTube to show more practical investing content to people who want clarity instead of noise. Now that we understand the real difference between VTI and VOO, let's make this practical. Who should choose VOO and who should choose VTI? VOO may make sense for investors who want clean S&P 500 exposure. If you want a simple large-cap core, VOO does that job well. If you want an ETF that is easy to explain and easy to track, VOO is very straightforward. If you already have small-cap or mid-cap exposure somewhere else, VOO may fit better as the large-cap part of the portfolio. And if your goal is to own the largest companies in America through one simple ETF, VOO is a strong option. But remember the trade-off. VOO is powerful, but narrower. It gives you the S&P 500. It does not give you the full U.S. stock market. So VOO can be excellent, but it should have a clear role. VOO can work well as a portfolio core. It can be the U.S. large-cap growth engine. It can be the foundation of a simple stock portfolio, and it can be the main holding for investors who want to keep things clean. But a core is not always the entire portfolio. Some investors may add international stocks, some may add bonds, some may add small cap exposure, some may add dividend or quality tilts. The key is intention. VOO should not be something you buy just because everyone online talks about it. It should have a job. If its job is U.S. large-cap core exposure, it can do that job very well. Now let's look at the investor who may prefer VTI instead. VTI may make sense for investors who want broader U.S. market exposure. If you do not want to decide between large caps, mid caps, and small caps, VTI solves that problem with one ETF. It gives you more of the U.S. stock market. That can be appealing for investors who want a one-fund domestic stock core. VTI also reduces the need to add a separate small cap or mid cap ETF just to get exposure beyond the S&P 500. But again, the details matter. VTI is broader, but not equally weighted. Large companies still dominate, so investors should not assume that VTI is a totally different animal from VOO. It is broader, but it is still very connected to the same large cap market forces. VTI can work as a one-fund U.S. stock market core. That is its biggest appeal. You buy one ETF and you get large caps, mid caps, small caps, and micro caps in a single fund. For many investors, that simplicity is powerful. Instead of asking whether small caps will outperform this year, VTI says own the market. Instead of building a complicated domestic stock allocation, VTI keeps it broad. But VTI is still only U.S. stock exposure. It does not replace international diversification. It does not replace bonds. It does not replace an emergency fund. So VTI can be a strong U.S. core, but like VOO, it still has to fit inside the bigger portfolio plan. That plan may change depending on the account. Account type matters. In a Roth IRA, both VTI and VOO can work as long-term core holdings. In a taxable brokerage account, investors should think carefully before selling one ETF just to buy the other because taxes may matter. In a 401k, the exact ticker may not even be available. You might not see VTI or VOO. Instead, you might see an S&P 500 index fund or a total market index fund. That is fine. The ticker is not always the important part. The exposure is. So instead of searching only for the letters VTI or VOO, ask what role the fund plays. Is it S&P 500 exposure? Is it total U.S. market exposure? Is it low cost? That is what matters. This is especially important inside a 401k. Many retirement plans do not offer every ETF you see online, but they may offer similar exposure through mutual funds or institutional index funds. So if VOO is not available, look for a low-cost S&P 500 index fund. If VTI is not available, look for a low-cost total U.S. stock market fund. The role matters more than the ticker. This mindset helps investors avoid unnecessary frustration. You do not need the exact product if the available fund gives you the exposure you need at a reasonable cost. That is how you think like a portfolio builder, not a ticker collector. And this brings us back to one of the biggest mistakes investors make with VTI and VOO, buying both without a reason. The common mistake is buying both VTI and VOO by accident. An investor buys VOO because they heard the S&P 500 is great. Then they buy VTI because they heard total market investing is great. Both statements can be true, but owning both may not change the portfolio as much as they think. The result can be more tickers, more overlap, and more complexity without much new exposure. If you own both for a deliberate reason, that is different, but if you cannot explain why you own both, you may not need both. A good portfolio is not built by collecting every good ETF. It is built by giving each ETF a clear job, and sometimes one clean fund does the job better than two overlapping funds. The bigger diversification question may not be VTI versus VOO. It may be U.S. exposure plus international exposure. For example, VTI plus VXUS gives you total U.S. market exposure and international stock exposure. VOO plus VXUS gives you U.S. large cap exposure and international stock exposure. In many portfolios, adding international stocks may change the diversification profile more than switching between VTI and VOO. That does not mean every investor must own international stocks, but it does mean the portfolio question is bigger than one ticker battle. VTI versus VOO is useful, but it is only one part of portfolio design. The real goal is to build a portfolio with clear roles, low costs, and a structure you can actually stick with. Now we can make the final verdict. So which ETF should you buy in 2026? Here is the balanced answer. If you want simple S&P 500 exposure, VOO is the cleaner choice. If you want broader U.S. stock market exposure, VTI is the more complete choice. If you're a beginner who wants one ETF for U.S. stocks, VTI may feel more complete because it includes more of the market. If you prefer large cap simplicity and trust the S&P 500 as your core, VOO may be easier to understand and hold. If you already own one of them, you probably do not need to rush and switch. And if you're buying both, check the overlap first. The best ETF is not the one that wins an internet argument, it is the one that fits the role. The cleanest way to decide is by role. What exposure do you want? How simple do you want the portfolio? What risk are you comfortable holding? And which ETF can you consistently fund without second-guessing yourself every time the market moves? For some investors, that answer is VOO. For others, it is VTI. And for many investors, the difference may matter less than their behavior. Because an investor who understands the fund, keeps investing, avoids panic, and holds long-term may do better than someone who keeps switching between good ETFs looking for the perfect answer. The right ETF is the one you understand, fund, and hold. That is simple, but simple is not always easy. VTI and VOO are both strong ETFs. The difference is not quality. The difference is exposure. VOO gives you clean S&P 500 exposure. VTI gives you broader total U.S. market exposure. Both are low cost, both can work for long-term investors. Both can be used poorly if the investor does not understand the role. So do not choose based only on what is trending. Choose based on the plan. Understand what you own, fund it consistently, hold it through market noise, and avoid adding complexity just because another ticker sounds good. That is boring investing. And boring investing works because it is easier to repeat. Boring money usually wins because boring money usually survives.